Hello guys, welcome back to my channel. Don't forget to like, share, comment, and subscribe the channel. Explainer how emerging costs come to treat Europe's energy firms. Soaring power and gas prices have rocked energy companies across Europe, forcing utilities and traders to secure extra funds from governments and banks to cover margin call requirements. Below is an outline of how they got to this point. Europe has thousands of energy firms operating in a liberalized power and gas market intended to provide guaranteed competitive prices. Signs of market strength started appearing quickly in 2022 with an unprecedented jump in European gas and power prices due to a confluence of factors, including high post-pandemic energy demand, cuts to Russian gas supply in the wake of the war in Ukraine, and unusually low nuclear and hydropower generation. To manage risk, several producers sell some of their power up to 3 years in advance on exchange, but this also requires making security deposits to guarantee future deliveries in case of default. These deposits, known as margin calls, have risen sharply in line with prices, leaving several companies badly exposed to bankruptcy as they are unable to find cash fast enough. To avoid insolvencies, government and regulators are now stepping in to help provide access to fresh money. Wholesale and exchange-based commodity markets such as gas, power, coal, and oil require down payments from utilities to cover open liabilities, which rise when there are unusually wide price fluctuations. Selling future output ahead necessitates paying buyers a safety deposit or margin in case the producer cannot deliver. Once the supply is received, the producer gets their money back. Germany's benchmark power contract for 2023 surged to a record high of 1.50 euros a megawatt hour in late August, 14 times the level a year ago. Benchmark European gas prices have surged up to 340% in a year. Norwegian energy group Equinor estimates that European companies need at least 1.5 trillion euros to cover the cost of their exposure to soaring gas and power prices, and that does not include Britain. Europe's energy crisis has taken the biggest toll on companies needing fossil fuel raw materials and has been easier to negative for those with more renewable in their portfolio. Generally, those with deeper financial reserves are a bit better protected than medium and smaller power generation operators or companies with large trading activities. However, big players with large forward sales positions are feeling the strain, among them Finland's Fortum and Swiss power company Expo, both of which are now getting financial guarantees from the government. Britain's largest energy supplier, Centrica, is reportedly seeking fresh money from banks, while Danish energy trades Dansk Commodities has secured extra funds from parent company Equinor. Meanwhile, Germany's biggest generator RWE has three syndicated loans totaling 8 billion euros to secure forward transactions and has a mixed portfolio that lessens exposure to costly gas. In addition to margin calls from exchange, the biggest importers and resellers of gas are struggling with the loss of cheap supply they expected from Russia and the need to buy replacement volumes on the spot market at elevated prices. For example, Uniper, Germany's biggest importer of Russian gas, burned through its cash reserves sourcing gas on the expensive spot market after Moscow's last flows to Germany, prompting a 15 billion euro bailout from Berlin agreed in July. Okay, that's all from me. Thank you for watching. Don't forget to like, share, comment, and subscribe. Thank you.